Hey, what's up, everybody? Wednesday, April 27th. Yesterday I was traveling. I'm out here in sunny Southern California for a couple of days. So yesterday I couldn't make a video. Another big down day yesterday. Today we tried to get a market recovery, but it was a feeble recovery. Sentiment is really negative. Put call ratio very elevated. I'm sure the AAII weekly sentiment survey will get that tonight for the week ending today. I'm sure that's going to show, as it has been showing, like really extremely low levels of bullish sentiment, high levels of bearish sentiment. One of the things that is a problem for the market right now, and it's something that I mentioned on Monday, is the fact that tax deposits have drained an enormous amount of cash from the system. Now, you know, some of you have asked me, well, isn't that a good thing, that reserve drain? It is for the banks and the banks' ability to add loans, but lending, you know, it takes time to percolate through the economy. We are in a very significant lending upturn, and that's going to accelerate, and it will keep the economy, I believe, from falling into recession. But right now, you know, the stock market is psychologically focused on interest rates and inflation, as I've been saying. But this drain that happened through, and this was a record tax haul. If you look at the TGA right now, that's the Treasury General Account, it's almost back to $1 trillion. As of yesterday, I believe it was at something like 975 billion. It has shot up like about 400 billion in the last week. That's a big drain. Here we go. I mean, no matter where I am, you're going to hear sirens or cars going back, I guess. So that tax drain right now is, I'll be honest, it's problematic for the market. Now, ultimately, that tax haul by the government is going to be spent back out. I mean, we're still under the debt ceiling constraint, so Treasury is going to eventually spend that money back out. But it's not like it comes in 400 billion in one day and it goes out 400 billion the next day. You know, it's like dribble, drabble, goes out, you know, 20 billion, 25 billion a day. Yesterday was a really weak day of like 14.7 billion. So it takes some time. I mean, that's how come you've often heard this. If you've been around Wall Street any length of time, you've probably heard the saying, sell in May and walk away. That's an old adage that's been around on the street for a long time, and there's a seasonal reason behind that. That is precisely because of this tax drain. So that money's going to be spent out and then some, because, you know, government is running the deficit. Even though the deficit is shrinking, it's still a deficit. So net spending, you know, spending minus taxation, is still positive. But again, this is a drain on the market's ability to rebound. And we're coming into the Fed meeting on May 4th. Now, I got to reiterate something that I have been saying now for a long time about monetary policy in the Fed. And that is, you know, everybody out there is of the opinion that the Fed is about to crash the market. I mean, this is a universally held belief, and it would be very rare, I think, number one, just from a psychological trading perspective, I think it would be very rare to have some kind of universal belief pan out as truth, as an actuality in the market. I'm not saying that never happens, but it's rare. You normally don't see that happen. I can name one instance where it has been true over the past year, and I think there was kind of like a universal view that inflation was going to rise, and that did happen. As a matter of fact, maybe the twist in that view was that nobody thought it was going to rise as fast as it did. And frankly, to be honest, I was one of those people, and I still believe that if we didn't have the war And those sanctions, the sanctions really threw gasoline on the fire when the fire was about to go out. I mean, we saw signs prior to the war and prior to the sanctions and the disruption with the oil and everything else like that, where we started to see some abatement, so some pullback in commodity prices as supply chains and this and that, COVID-related, pandemic-related disruptions started to ease. And then we got into the war. So that was, one black swan event on top of another. Very hard to predict that sort of thing, but that happened. Anyway, that is the psychological focus of the market right now. And again, it fascinates me, and I know I've said this so many times, but it fascinates me, the grip that monetary policy and this fixation on monetary policy has on the overall, financial market environment. I mean, you cannot read or listen to any commentary that is not solely, uniquely discussing and focused on monetary policy and interest rates, as if interest rates were the panacea for everything. It was the be-all, cure-all for everything. You got slow growth, you lower interest rates. You got inflation, you raise interest rates. You got whatever it is. This has been embraced. This is a belief system. This is an ironclad, deeply, deeply held belief system that interest rates are a panacea. They are a solution or a problem to everything. If ever there's a problem, it goes back to interest rates. If ever there's a solution, or if you want to find a solution, it goes back to interest rates. To me, this is just a fascinating, kind of dogma, for lack of a better word. It's like stating opinion as if it were fact, without really the understanding, as I've been through so many times, of what interest rates. Like, I'll give you an example. I saw a tweet today. I think, the guy was a very heavily followed on Twitter. He had hundreds of thousands, I think, of followers. And he talked about, there's 34 trillion of debt. And he was referring to like private sector debt. There's 34 trillion of private sector debt. If you think that a 5% interest rate is not going to have an effect, you better think again. All right? Now, on the surface, that sounds like a totally reasonable statement. But at the same time, it completely ignores the fact that there's 25 trillion. The non-government, the private sector, is a holder of 25 trillion of government debt, and the rise in interest rates flows to them in the form of higher income. So I could say, if you think that is not going to have an effect, then you better think again. So the point I'm making here is that the entire, one entire side of a balance sheet or a cash flow statement is completely ignored, as if we live in some kind of a, universe where it only has an effect. Look, physics, what is it? Newton's second law of thermodynamics or something like that. For every action, there is an equal but opposite reaction. Same thing in finance and accounting. I mean, somebody is getting paid that money. Okay? So yes, this is the point I've tried to make so many times. It applies to inflation. It applies to deflation. I mean, there's a winner and there's a loser. Like, we don't like paying more for stuff. I get it. Consumers don't like paying more for stuff. But there's a counterparty, there's a cohort on the other side of that transaction. The money we pay is going to them. So unless we're talking about foreign flows, which, by the way, today, the U.S. trade deficit in goods hit an all-time record high. So that is a problem, okay? Even with the big rise in petroleum exports, we're still running record trade deficits. So I get it. That is a net outflow of income to the foreign sector. We lose that. That goes to the foreign sector. You know, I like to say, well, the income doesn't fly out into outer space. No, but it can fly out to the foreign sector. In other words, that's money that goes out to the foreign sector. It doesn't remain in the economy. Nevertheless, it's really, really important to understand that, like Newton said, for every action there is an equal but opposite reaction. I mean, the money we pay, higher prices for whatever, for food, for gasoline, for transportation, for airline tickets, for hotel accommodations, for clothes, I don't know, you name it. That's money being paid to somebody. They're receiving that as higher income. I mean, it's ludicrous to claim you're making some kind of educated analysis when half the equation is being left out. I mean, it's just crazy. But that is what's going on right now. And I stand by my belief that when we actually start to see Fed policy in action, in other words, when they start raising interest rates, and I saw Cramer today on a video. I saw Jim Cramer saying, Bullard, Fed President Bullard, he's my guy. He's my guy because he wants to go 75. He's my guy. 75 basis points. I'm just laughing. I mean, it's like so silly. It's ridiculous. He's my guy. He wants to go 75. He's my guy. Again, yeah, people are going to pay more on their debt, but that interest is going to flow not just to, banks and financial companies that are the creditors, but it will flow also to the holders of 25 trillion. That is total public debt, the government debt held by the public. I mean, there's another 6 trillion that the government holds itself, interagency debt. I'm not even counting that, but we can count that if you want. I mean, that's 30 trillion. That's going to improve those balances on those government agencies. I mean, that's 30 trillion. That's the, the national debt, quote unquote. The interest rates go higher. Yes, we pay, but the holders of that 30 trillion, they earn more. So I'm sticking by my view that once this gets going, once we get the actual increase in the rates and the Fed, starts quote unquote putting on the brakes, I think that's going to be the bottom of this correction. I think this is one of these buy the rumor, sell the news types of scenarios. I think it's very, very much built in psychologically, price-wise into the market right now. I mean, some of these, a lot of these, I should say, tech stocks are trading like deep value stocks right now. So let's see what happens. Anyway, I know some of you were asking me why there was no video yesterday. And it's because I was traveling, so I'll be back in New York on Friday, but I'll be doing the videos from here, sunny Southern California, for another day or two. All right, everybody, take it easy. Bye.